You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back once again to talk about all things futures options. Yes, it is time for TWIFO. This Week in Futures Options, a program where the name says it all. My name, of course, Mark Longo from theoptionsinsider.com, as well as from the ever scintillating, ever engaging, at least we tend to think so, Options Insider Radio Network. Remember, if you do like what you hear, when we have seen a massive influx to the network and indeed to TWIFO over the last 6 months in particular. A lot of people really discovering the world of futures options. The show's been running for a long time, obviously, but we love to see new listeners joining all the time. So if you do like what you hear, you want to keep the new folks discovering the show, then throw some stars on whatever platform you're listening on. It does help the new folks discover the content. Again, record numbers for the options market last month. More people trading options than ever before. So help them beat a path to the world of TWIFO. And then, of course, if you want to go above and beyond, you want more content in your lives than just what we offer on the on-demand side on the network, then, of course, theoptionsinsider.com/pro is the place to go for more. You get, of course, pro Q&A sessions, some of the best minds in the world of options and derivatives, including you get a double dose of pro Q&As this week. So get ready for that, as well as, of course, Options Oddities, where we break down all of the unusual activity that's lighting up our tape for the entire week. So if you can't find something to trade there, you're really not doing it right. And then, of course, live access to this, everything else we do here, giveaways, a whole bunch more. Theoptionsinsider.com/pro is the place to go to learn all about it. As we go out now to the CME Group hot seat and see who's joining us on the TWIFO program this week, I'm pleased to be joined by a newcomer to the program and indeed to the network. He is Jim Roemer, a meteorologist and founder of Best Weather Inc. Jim, welcome to This Week in Futures Options.
Great to be on the show. Thank you, Mark.
And Jim, as we are wont to do with all of our first-timers here, why don't you go ahead and give our audience a bit of an overview of your background, as well as what it is you folks do over there at Best Weather Inc.
Okay, thank you. Yeah, well, I studied meteorology my whole life. I knew when I was 5 years old, being caught in a snowstorm in New Jersey. My God, I want to be in the weather forecast business, right? So I pursued that. And back in the early to mid-'80s, after college, drove about 2,000 miles with a broken muffler all the way to Des Moines, Iowa. I did not even know where the Corn Belt was at the time. Well, sure enough, within 5 or 10 years, I became an expert in agriculture and commodity trading, working for a small firm called Freeze Notice Weather in Des Moines. And over the last 25 to 30 years, advising farmers, hedge funds, traders, really about the power of weather, particularly with what's going on in the world, all these crazy cycles of climate change and La Nina, incredible volatility, which is great for options trading and many, many markets affected by weather, from corn to soybeans, natural gas, sugar, coffee, you name it. I watch weather all over the world. I have a newsletter called Weather Wealth. You can look at my website and get a free issue, and basically discusses trading in agricultural markets and also energies based on the weather.
Sounds like we're going to have a great show here, Jim. I'm looking forward to it. But before we do that, we have to kick things off the way we always do. It is time for the Movers and Shakers Report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report, where we break down everything moving to the light side, a.k.a. the upside, and to the dark side over there at CME Group this week. If you want to see this report, it's one of the premium reports that we put out there for free for you folks from our friends over there at Bantix. Remember, if you want to see all the stuff they have cooking over there, we really just scratched the surface. Head on over to Bantix.com, Bantix.com. Tell Nick and Company that we sent you. They'll be happy to walk you through everything that they have to offer, really just scratching the surface there, including this report here, which, again, one of the premium reports you can find if you follow us at Options, or, of course, if you follow CME Group. They do tweet it out right before showtime as well. Mr. Jim, it is time, sir. Where should we begin our journey this week? To the light side or to the dark side?
Well, how about the light side?
All right, to the light side we go. And by the way, listeners, it is a mostly red week. I would say 70-30, maybe even 80-20, red over green. So not a ton of light side out there today, but nonetheless, we'll see what we can dig up. Number 5 to the light side this week. Oh, right up your alley, Jim. We're going out over to good old Chicago wheat, SRW wheat, up about 1.5% on the wheat. So we're kicking things off in ag, staying in ags for number 4 with oats up nearly 2%, 1.96% to be precise. Then we're heading off to metals for number 3, listeners. Platinum up 4.08%. It was number 4 in the same direction last week, up 3.89%. So a good couple of weeks here for platinum. Then we're heading over to energy. Number 2, it's nat gas, one of our frequent offenders this week, back up 6.05%. And the number 1 light side mover this week, back to the metals, it is palladium, up a little over 8, about 8.08%. All right, now to the dark side we go, listeners. Number 5, we have Brent, off about 4.75%. Number 4, it's Bitcoin. That's 2 of our frequent offenders right there, listeners. Bitcoin off 5 and about 5.5%, 5.54% to be precise. It was our number 1 light side mover last week, up nearly 9%. So given a good chunk of that back this week. Number 3, back to energy. It's WTI off 5.6%. And we're going to stay in energy the rest of the dark side, listeners. Spoiler alert. Number 2, we got heating oil off 6.02%. And the number 1 dark side mover, it's RBOB off 8.73%. So an interesting selection lighting up our tape here this week. But because we have Jim in the hot seat, we're going to kick things off in the world of ags.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, everyone, welcome to the wonderful, the topsy-turvy world of ags. If you folks want to follow along with the show, remember, you can do it while you're listening to the show. You could do it at 2 a.m. on Sunday if the mood strikes you. Just head on over to CMEgroup.com/TWIFO, TWIFO. That's the place to go to get all these reports that we generate for the show completely for free because we like you folks. Get over there to that drop down, and then you're going to go right to the top. It is an alpha order list after all. And then select agriculture from the asset class list. And then we're off to the races. Jim, Obviously, there's a lot of different ags we could talk about on the show this week. You are our guest. I will allow you to choose where we begin our journey in the ags world. What's lighting up your tape the most this week, sir?
Well, actually, from the light side, sugar has exploded about 25% the last 6 months, 10% in a week, and it's really weather-related, actually.
All right, well, let's get into it then, sir. What is catching your eye and what is driving all this action in the world of sugar, a product which we don't really make into our rotation every week here on the show, sir?
Well, there's an ETF called cane, and of course, in options, the volatility has skyrocketed here with about a 20% move over the last few months. Sugar basically has grown, number one, in India, 2 in Brazil, and 3 in Thailand. All 3 countries are having either flooding or droughts right now. And you can tell that it's a bull market in sugar. We broke above a 12-year trend line today. It's a bull market because with lower crude oil prices, typically you see lower sugar prices. When crude oil prices are lower, then Brazilians and other countries around the world produce less ethanol, more sugar cane, and that tends to pressure sugar. That's not the case. Lower sugar right now, lower crude oil prices right now, which should mean lower sugar prices, is not happening. Sugar prices are exploding, and as a result of weather problems around the world and a potential El Nino phenomenon, we could see another 10 to 15% up over the next 3 to 6 months.
Sugar, again, not a product that makes it into our rotation every week, not a huge options product out there at the end of the day. Let's get into some products that are driving a lot of interest from an options perspective. And since we had Chicago wheat, number 5 on the dark side, I know wheat's a big driver for you over there, Jim, as well. We're going to kick things off over there first. So again, from that asset class, going to ags, then going to grains and oil seeds, you're going to see in the product category down 2 slots to SRW wheat, aka Chicago wheat. Where's this hanging out right now? Hanging out 667.75, off about 14.75, or a little over 2, about 2.2%. Just this week, obviously, if you go back to the end of our show last week, it's actually net up. So it's been a rocking week out here for a good old Chicago wheat, up about 1.5% from the end of our show this time last week. And how much paper on the tape? Decently active week, about 126,000 contracts on the tape for good old SRW wheat. Now, Jim, I know you spent a lot of time analyzing the wheat markets, KC wheat, Chicago wheat. What's catching your eye out there in the world of wheat these days?
Yeah, well, in my Weather Wealth newsletter, we have people long wheat on these droughts in Kansas, Texas, and Oklahoma. The number one producer in the world of wheat, a 3-year drought. But I put out a forecast the last couple of days that with this La Nina weakening, we're begin to see some really important rains into the heart of the wheat areas in the United States. And as a result, buying put options longer term with improving global weather is something that I just recommended to my clients. I'm pretty bearish as we get into the spring and summer with the wheat market.
Buy and put options. Interesting. Well, let's see if that is playing out here on CME this week. Like we said, about 126,000 contracts on the tape. And 48.5% of this, Jim, is going up in the May contract that has 1 day to go. So it's almost like an equity, very near dated paper. Jim, that is not the type of flow we usually see in the ags. The ags are not an equity. They're usually a little bit longer dated. Does it surprise you that nearly half of the volume we're seeing this week is effectively going out tomorrow, Jim?
The option to do is really July wheat. The crop is harvested during the summer, and the weather's the most important now for crops for the next 2 or 3 months. So buying put options 2 days ago in July wheat puts, so that trade will probably make 25 or 30% over the next few months.
July wheat. Well, let's see what's going on out here. Looks like right now, like we said, the big dog is the May contract, but let's go a little bit farther out. Since you're talking about July here, Jim, let's go and see what's going on out there. They did about 20% of the paper this week, so we could certainly hang our hat out there as well. That's why I like the ags. There's always a nice, healthy smattering of liquidity across the term structure to sink our teeth into. So out to July we go. That has about 64 days to expire. Listeners, the future out there a little bit higher, 679.75 out there. What is the vol in July wheat, you may be asking? Well, it's pretty much in that range that most of our products are in the low 20s up to the low 30s. This hangs out at about a 32.10 or so right now, up about 0.7 of a point on the week. So vol getting a little bit frothier out there in July wheat. In terms of the skew, let's see. The skew in the ags is always interesting. Usually it's bid to the upside, listeners, so kind of the inverse of what we see in the equities and a lot of other products out there. And that remains the case again this week. The skew out there in July, last week the puts were 7.4% cheap. This week, 8.2% cheap, so still no one wants the puts. And the calls last week, 12% bid. Coming in a little bit this week, they're about 10.1% bid. So interesting stuff out there. And in terms of action, what was the most active contract out here in the wheat this week, listeners? The Chicago wheat. It was the 1 day to go, 700 calls. Remember I said we're hanging out at 667 in that front future. These 700s were pretty active all week long, about 8,000 contracts. The busiest day actually today, 2,600 today, 2,500 on Monday, 1,300 on Wednesday, and 1,600 on Tuesday. It looks like back and forth opening to closing throughout the week. So it looks like as we maybe threatened 700, then moved away from it, folks decided to get in and they get the heck out of Dodge. So interesting back and forth in terms of paper out there on these par calls. A little bit below it, you might think a little bit of put action would be the order of the day this week. There were the 650 puts going up this week, also expiring tomorrow. About 5,600 of those going up this week. Almost all of that, 5,100 was on Monday. And looks like folks were abandoning those puts in mass. So a lot of folks dumping the 6.5 puts in May this week, which is kind of interesting. We saw similar paper on the 670 puts, about 5,500 of those going up this week. But unlike the 650 puts, these traded pretty actively all week long, with the exception of Tuesday. We saw over 1,000 trading every day, 2,300 today. So again, back and forth, opening to closing. So kind of interesting how the 6.5 puts, all of them on Monday, and the 670 puts a little bit more evenly spread throughout the week. Let's scroll a little bit farther down to see if we see any other interesting and or aberrant paper. Jim was just talking about the July puts. Let's see if any interesting paper out here in July. It's like leading the dance in July. I said that future a little bit higher, listeners, 679. It was the 800 calls, doing about 2,500 contracts this week that were leading the dance, mostly opening in July. Jim, does that come as a surprise to you? You were talking about the puts, but the most active contract we have out here in July this week are the 800 calls, opening for some size this week, sir.
Yeah, I mean, lots of farmers around the world, hedgers, wheat producers tend to use more call options than puts. That's not surprising. You're not going to see wheat prices back to $8 over the next few months unless you see some major droughts either in Europe, Russia, or the United States. Things are improving worldwide. So those calls should expire worthless over the next few months.
You think people are mostly overriding those? They're farmers, like you said, against their existing positions, or you think they're an optimistic bunch gobbling up some 800 calls?
I think a lot of people are long that market, but as the weather turns and we begin to see hedge selling from farmers as crops improve around the world, we expect lower prices. You begin to see a lot of liquidation on those long call options, and farmers are actually probably shorting call options as we go into the spring and summer. Also, Kansas City wheat, real quickly, is much higher priced than Chicago wheat because, A, the Russian-Ukraine war. Hard red wheat used in bread is grown primarily in the Ukraine, the number 3 exporter in the world, and Kansas, Oklahoma, and Texas. That's why you've seen Kansas City wheat at a major historic premium over Chicago. So selling call options in Kansas City wheat and or buying puts is a much safer play. There's a heavier long position in that market. And when the weather turns, everyone's going to run for the hills. And you'll see KC wheat probably go a lot lower than Chicago wheat over the next probably 2 or 3 months.
I'm glad you brought that up. We have a live question coming in from one of our pro listeners. Along those same lines, I was going to save it for later, Jim, but you're talking Ukraine war, so let's get into it now. Options Queen wants to know how much of the price action and volatility that we're currently seeing in wheat and other ags is still attributable to the war in Ukraine, or is that already priced out of the market? Thanks. Obviously, Jim, we were all talking about wheat this time last year and all the impacts of Ukraine, and wheat shot up to stratospheric levels, and there was a lot of concern about global starvation as a result. Not as much now, but obviously the war in Ukraine still raging, still a factor. Options Queen, I'm sure a lot of our other listeners want to know how much of a factor really is it in the wheat market these days?
Yeah, well, quickly, I'll just back up for a second. The real big concern was the natural gas going to $10 and all this concern about the Russian-Ukraine war and Russia perhaps not exporting crude oil and particularly natural gas to Europe. We had a record warm winter, not only in the United States, but in Europe, and natural gas prices dropped puts and make like 6 to 10 times your money when natural gas went from $9.50 down to $2.50 in 3 months. But regarding wheat, I think a lot of this is priced into the market right now. The market's sick and tired of hearing about all these stories of Putin, back and forth, exports, no exports, how much we're going to plant. I think it's pretty much focused on other countries right now in the weather more than the Russian-Ukraine war in the wheat market for the moment.
All right, let's keep on rolling here. Since we're hanging out in Ags, Jim, and this is very much your bailiwick, we already talked about wheat. What else is lighting up your tape in the world of Ags that our listeners should pay attention to this week, Jim?
Well, again, in my newsletter, in the Weather Wealth newsletter, I think the biggest actually options play in probably in 4 months, other than being short natural gas long puts during the warm winter several months ago, was in coffee. We've seen coffee futures go from $1.72 to $2.03 earlier this week, a 20% move in less than 2 weeks. Buying some May call options about a week and a half ago, with with a week and a half to 2 weeks of time value left because of weather problems around the world. I think one would have made 8 to 10 times their money buying May calls 2 or 3 weeks ago in coffee. I think the move has already happened. The reason coffee is going up is tight supplies. We've had droughts in Brazil. We've had incredible flooding in Indonesia. We have lower crops around the world, and that's why coffee prices have spiked back to $2 earlier this week.
Great stuff. You check out his newsletter, listeners, if you want a deep dive into all things coffee. Unfortunately, not a huge options product for us to sink our teeth into here on the show this week. Speaking of not a huge options product, this is a question I've had about the ag space for some time. Maybe you can help me sort this out, Jim. As you can notice on our light side movers this week, we have oats coming in at number 4, up nearly 2%. Oats are typically a frequent offender. They move quite a bit. There is some volatility in this product. Yet when it comes to actual options volume, it's effectively non-existent. You might get 3 contracts in a week. So I'm curious. We've received this question a lot from our listeners. I'm going to put it to you now. Why don't we see more options volume in a fairly volatile product like oats, Jim?
It's a very volatile product. I think it has to do with how many farmers are producing it around the world that use it as a hedging platform. The daily volume is 1/10 to 1/20th in the futures contract at the CME and of what corn and soybeans are. And I just think it's surprising because it's a great crop. It's a great product. It's healthy. You would think more people would be trading it. But I think Canada, I think, is the number 1 and number 2 producer in the world. And the Northern Plains, North and South Dakota produce some. But it's just never really caught on because I think it's not really a hedging vehicle for many farmers. And as far as the liquidity of that market, we just haven't seen that in the futures contract like we have in corn, soybeans, and wheat over the last 50 years, basically.
Well, you mentioned one of our other frequent offenders these days in the ag space. It is soybeans. I'm hard-pressed, Jim, to think of another period, really, where we talked about soybeans as much as we have over the past few months. If either the soybeans themselves or the meal or the oil, some aspect of soybeans seems like it's making it onto our list just about every week here on the show. And notice, as you mentioned in your newsletter, the beans remain choppy, but the weather could turn things bearish coming up in November beans. So what are you on the lookout for these days? Sounds like a little bit of downside, Jim, in the beans.
I think so. Obviously with the tensions going on with China right now, whether hopefully, of course, they don't invade Taiwan, there's a lot of concern about demand, whether that's going to happen or not. The situation's gone from the Russian-Ukraine war now, the concerns about China, what they're going to do. That's something we really have to watch. But the most important factor from May through August, of course, will be northern hemispheric weather. As La Nina has weakened, if El Nino forms, we have the warm ocean currents off the coast of Peru. If that expands and we have an El Nino before June or July, then 70% of the time since 1960, we've seen soybean prices break during El Ninos anywhere from 10 to 30% between May and August. That's what I'm watching for right now. If that happens, then selling call options, for example, the $14 or $15 November soybean call. Remember, soybeans are harvested before November. That could be a good longer-term trade for your listeners and also for farmers following 2 or 3 years of droughts and higher soybean prices.
I love it. El Nino. You just invoked our buddy, Mr. Blue Putnam, the chief economist over there at CME Group. I never met an economist who loves El Nino and La Nina more than him, Jim. So he seems like he should have been born a weatherman. Every time he comes on, he loves himself a little bit of El Nino and La Nina. So you two will have to chat behind the scenes, I'm sure.
Can I tell you an interesting story? We have time?
Sure, go for it.
Yeah. So nobody really discussed El Nino. I mean, I was like only a few years old back then, until 1973 when the anchovies were wiped out off the coast of Peru. And as a supplement, soybean meal was used to feed livestock around the world because there weren't any anchovies around. They were all wiped out by this historical 73 El Nino. As a result, I think the Fed or whoever created a consumer price index took out some of the soybean meal and some of the other consumer food products in order to hide the inflationary spiral that occurred in the early 1970s because of El Nino. So in other words, we would have had double-digit inflation back then. And anyway, so what happens off the coast of South America has a huge impact on multiple commodities in many countries around the world. And obviously, there are many options plays you can use, or cooling ocean currents, or El Nino, which is the warming of ocean currents along the equatorial Pacific.
Jim, are you telling me that anchovies are to blame for our modern fixation on El Nino and La Nina? It all goes back to salted fish, sir?
Not exactly, but yeah, that's funny. Back in the 70s, it certainly was a major factor to actually stimulate the exports and imports of soybean meal as a supplement for anchovies. And of course, soybean meal today, 40, 50 years later, is one of the most active traded contracts at the CME.
Yet another reason for me to hate anchovies. Not only do they taste awful, but now they are to blame for our modern fixation with El Nino.
I hate them.
El Nino.
I don't like olives either.
Oh, there we go. We can agree to disagree on that one. The anchovies. I think we can both get behind. Let's see what we can get behind from a volume perspective out here in soybeans. Like I said, listeners, this has been a wild period for all things beans, and it's reflected here in the volume numbers. 304,000 contracts going up in the beans. That's starting to threaten some corn numbers out here. That's some pretty impressive volume. Where is soybeans right now, listeners? Hanging out at 14.97.5 in that front future. Again, that only has 1 day to go in the May contract. So we go a little bit beyond that. We drop down a little bit. So next month out, we have 14.68 is where that future is hanging out. Actually up 1.5 points on the week. Let's go a little bit farther out. See, and of course, just like we were talking about recently out there in the wheat, listeners, the ags are deciding to do their best equity impersonation. Everyone wants to be 0 day these days, apparently in the ags as well, because 52.5% of that 304,000 contracts went up in the May contract that's going to go away tomorrow. So it's not all 0 day, but it's pretty freaking close, listeners. It's kind of hard to analyze vol and things in the contract that's going out tomorrow. So let's go a little bit farther out. Listen, let's see what we can find. How about the July contract? Jim likes hanging out in July. Let's go out to July. That's about almost 15% of the paper went up there. That July future, 1468.75 right now. What is the vol in July beans? It's about a 17, a little bit shy of that, 1690, kind of unched on the week. So the beans, not a bastion for volatility. One of the few products that's kind of outside of that range of they usually see in the low 20s to high 30s. Of course, if you look at equity vol right now, VIX hitting the 16 as well. So maybe 16 is the new 20 out there from a vol perspective, listeners. In terms of skew, we had the puts last week. They were mostly flat, about 0.75% bid. Nothing really to write home about. This week, they've swung a little bit in the other direction, 1.3% cheap. Last week, it was all about the calls. 7.3% bid were the calls last week. This week, that has mostly evaporated back down to 1.2%. So the skew, slightly a bid to the calls, slightly offered to the puts, but it's mostly flat. So it seems like the option skew not really giving us a huge indication of what to expect next in the world of beans. And in terms of action, what was the most active contract out here, listeners? I said we're at a 1497.5 in that front future going out tomorrow. If you said it was the 1500 puts going out tomorrow, you are the winner chicken dinner. Nearly 25,000 of these things have gone up this week, and they've been pretty active all week long. 5,600 on Monday, 5,000 exactly on Tuesday, 7,700 yesterday, 6,300 today. Looks like opening all week long, so a lot of opening paper on this effectively at the money strike. Usually when you're hanging out at the money strike, usually you expect to see maybe a little bit of back and forth opening to closing throughout the week, but that is not the case. Looks like it's pretty much opening all the time out here in these 1,500 puts in May. Behind that, we have the 15-20 calls. So if the par put's not doing it, 15-20 calls going up about 20,500 times this week. The big day for those actually today, about 8,000 today, 6,700 on Tuesday, 4,300 on Monday, 1,600 on Wednesday. Looks like opening all week there as well. So opening on the par puts, opening on the 15-20 calls, a lot of opening paper on these contracts going the way of the dodo tomorrow. Right behind that, we have the 1490 puts, doing about 14,000 contracts. The big day for those also today. Today, a very active day for the beans, listeners. 5,001 contracts going up today, 4,410 yesterday, 2,200 on Tuesday, 2,600 on Monday. Again, mostly opening throughout the week as well. It looks like bringing up the rear there, we also have the 15-30 calls, 12,300 of those this week. The big day for those, not today. That's the one outlier. It actually was Tuesday for those. About 7,500 going up on Tuesday, mostly closing. 2,300 on Monday, and about 1,400 yesterday and 1,100 today. Before we pop out of beans, let's just scroll down a little bit farther. Usually there's always some interesting paper going up a little bit farther out here in most of the ags, and that is the case again this week. If we go, listeners, all the way out to the November contract, we have the November 1420s. Interesting. By the way, the future out there is at a 1,300, so substantially lower there, listeners. We have the November 1420s going up 5,500 times this week. The lion's share of that on Wednesday, about 3,800 yesterday, 1,300 today. Not much to speak of the rest of the week. Mostly opening on Wednesday. So some folks piling in to some November 1420s in the beans as well. That's fascinating stuff. But as you mentioned a couple of times here, Jim, you're not all about the ags. You're also a watcher of one of our frequent offenders here on the show, Nat Gas. So let's talk about a little bit of energy next.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody, welcome to the very, very interesting, very volatile world of energy these days. Pop out of that, drop down over there at cmegroup.com/TWIFO. Pop out of ags, which are obviously at the top of the list. Go down 2 more slots in the asset class to energy. Then we're going to kick things off in nat gas. Where we go from there, listeners, is anyone's guess. Jim, it has been a fascinating, just watching the saga that has been nat gas over the last year. Truly one of the more fascinating products on the show. I can recall a time when nat gas was fairly sleepy. If it broke through $3 to the upside, that was a big deal. There was a lot of hand-wringing, a lot of madness went on. And then, of course, last year, the war in Ukraine and nat gas shot up to the stratospheric levels it hit. We were talking here on the show, $8, $9, $10 calls with regularity, even some chatter about 12 and 15s. It was insane. It was an insane time there, Jim. So walk us through that from your perspective. You've obviously been watching this market for a long time. How surprised were you at the insane levels we hit last year? And then, of course, maybe equally surprised at this sell-off we've seen.
It's incredible. Mark, commodities tend to just be over-exaggerated to the upside and to the downside. Just sometimes they don't make sense. And certainly that's the case with natural gas. The last time we saw a natural gas explosion like we had last summer and fall was during Hurricane Katrina, when 70% of all the Gulf Coast natural gas production was in the Gulf of Mexico, and it knocked out the facilities for months, right? So natural gas has spiked unbelievably during Katrina back in 2005. Well, since then, shale production has increased, less natural gas produced in the Gulf, only about 20 or 30%. We really haven't seen natural gas above $3 to $4 for the last 15 to 17 years, really, even with some cold winters until last summer. And that was all brought about the combination of a record hot summer in the Midwest, more utility companies switching to natural gas from coal and nuclear power, and also the historic multi-year drought in California and the Pacific Northwest meant no water, no hydropower the last 2 or 3 summers, a lot of increase in natural gas usage out west. And then you have the Russian-Ukraine war, of course, Mark, right? All this panic by European producers, utility companies. Oh, my goodness, we got to buy natural gas 7. No, now we have to buy it at 8. No, now we have to buy it at 9. They were concerned about a cold winter and Russia cutting off exports. Well, as it turned out, It was one of the warmest winters on record. So all these utility companies, all these producers were stuck with record supplies of natural gas here with a record global warm winter. And that's why prices have dropped, 70% since last October? Unbelievable.
Yeah, if you look back at what people were prognosticating, this time a year ago, they were looking out to just an apocalypse. No one can get gas, $10+ out there for nat gas. It was insane. And then you're right. Now we're at $2.25 right now. It sounds like Nichols in our live chat is echoing the sentiment I know I've had, a lot of our listeners have had as well. He wants to know, Jim, are you surprised at the big sell-off we've seen in nat gas going from threatening 10 and now to around the 2 handle, sir?
Well, I am. Well, let me back up. Back in October, November, in my newsletter, Weather Wealth, I really saw a warm winter, and I recommended buying when prices were about $7.50 to $8.50, some like $6 puts for December and January delivery. Those did really, really well. However, I never expected the market to go below $3.50. I mean, that's unbelievable, and that's because of all these European countries, just panicking, filling up their tanks with natural gas, and no place to put it. So there was an overreaction of probably $1.50 in natural gas over the last 2 or 3 months to the downside.
Yeah, it has been just absolutely fascinating to watch. Again, not a product we talked about a ton, and it's been on our radar aggressively. It is one of our frequent offenders now out here on the show. So just a crazy time. Speaking of frequent offenders, it is certainly offending from a volume perspective this week, listeners. We usually see nat gas this time of the week, 400, maybe 440, 450 on a pretty active week. We're looking at 660,000 contracts on the tape right now, listeners. By the way, nat gas looking at about almost 2.25, 225 or so out there, up about 13 cents on the week, a little bit of a rally out there. Before I get into the options paper here, Jim, I know you have a lot of clients here who are looking at nat gas and you're advising them on the ebbs and flows in this product. Which way are you leaning from an options perspective in nat gas these days? Or maybe are you staying away from it? Is it just too volatile for you?
It's been volatile. We have to get into the summer. And I think if we have a hot summer, most of my research suggests we may again. I don't know if we're going to go to $4 or $5. So buying call options may not make sense because there's so much oversupply. But selling put options, for example, the odds of us going below $2 or $2.30 in July natural gas or August natural gas puts is probably under 10 or 20%. It's going to take an incredibly cool late spring and summer to go anywhere close to $2 in the July or August contract. So it's conservative. You're not going to become rich on that, but there's enough premium that maybe, like, for example, selling the July 230 put and for protection, buying 150 put against it, you'll make $2,000 a contract with probably very low risk over the next 3 or 4 months.
Interesting. I'm getting a theme to your trades. You like your July, Jim. That's your time frame.
I think actually, if July is warmer than normal, which is very possible, maybe selling August puts because they expire a little bit later, and you have more time value, and you have to collect a little bit more premium. So maybe going out to August, September. The thing is, with El Nino forming, we're not going to have an active hurricane season this year, and everyone jumps on board when we ever see a hurricane, right? If we don't have an active hurricane season and the second half of the summer is not hot, only the first half, then any spike we may see in natural gas back to, say, $3, for example, maybe, will be short-lived. I don't see the market getting back above $3.50 anytime soon, or maybe even into the beginning of the winter.
Yeah, I have to say I don't hate that. And obviously, we bounced pretty aggressively off the 2-handle before. So intriguing stuff. We kind of flirted with it ever so briefly. But intriguing stuff. So maybe you like a little bit of premium harvesting on the 2-handle, listeners. And perhaps selling some of those puts is for you. How far out do you like to go? You like to go a little bit more near dated, or you like to go a little bit farther out? Right now, again, in keeping with the trend, everything short duration is king now, Jim. We have 30% of that 660,000 contracts going away in 5 days. The May contract goes out in 5 days. So it's all front month all the time in all the ags these days, listeners. So that 0-day contagion has spread to the ags as well. What is the vol out here? You might be wondering. In nat gas, it's historically a fairly volatile product, usually the most volatile product we talk about here on the show, unless Bitcoin or some of the other cryptos are up to no good. Outside of those scenarios, usually nat gas threatening triple digits. It's at the top of the list. It has come in substantially. That front contract's at an 81.5. If we go out a little bit farther, let's go out to June, listeners. That gives us a nice 35 days. That vol is at about 71.5. That one's down about 7.75 points as well. So vol coming in precipitously out here in nat gas. So obviously still very volatile, still volatile than 90% of everything else we're going to talk about here on the show this week, but far away from the threatening triple digits level it was at not too long ago. So maybe if you were a little spooked, I know we had Carly Garner on here not too long ago. She was saying maybe this is a market to avoid in nat gas, a little bit too volatile. Maybe the vol coming in a little bit, and maybe Jim's idea about harvesting some premium, maybe that can lure you back to the dark side. Getting a little bit less juice for that, obviously, but also the odds you're going to get run over on those puts a little bit lower as well. Let's go out to the June contract, see what's going out there from a skew perspective. Last week, the puts were bid, 6.6% bid. The calls were 4% cheap. That's the way it's been for a while. I don't know, Jim, that's kind of perplexed me a little bit as well, because we've seen a lot of guests come on and sharing similar outlooks to you, saying they think the downside is mostly in nat gas. Most of the opportunity, most of the interest is to the upside. And yet, a week after week here on the show, we talk about a skew where the calls are offered and the puts are bid, like people are gearing up for another big downside move. That always surprises me. Does that surprise you out there, Jim?
It does at this time of the year. I mean, as you get into the spring, you tend to have less demand, and volatility usually goes down in natural gas till probably June or July. But I think a lot of people are spooked. So that's the time to be getting in. When everybody's panicking and selling, right, natural gas, maybe that's the time to actually buy it. When everyone's buying coffee and you have the commitment of traders is heavily long, that's the time to be looking to sell it if the weather cooperates. And that's what I try to do, is piece together not only options volatility and delta, look at the commitment of traders, but really honing in on how the weather is affecting both crop production, natural gas demand, and also really investor psychology is so key in many of these markets.
Yeah, and a guy like you looking to harvest a little bit of premium on the puts, maybe a little bit of a bid to the put wing isn't the worst thing at the end of the day, Jim. Let's keep on looking out here and see what we've got going. Like we said, the puts bid last week, still bid this week, 4.4% bid. They come in about 2 points. The calls last week, 4% cheap. This week, 5% cheap. So nobody wants the calls this week either. There you go. If you want to buy some upside or sell some downside, still looking decently favorable. It's not a super aggressive skew in either direction, but it's not nothing either. In terms of action, listeners, it was all two puts and below this week. That's where all the action was. It was the two puts going out in 5 days that were leading the dance this week. 37, almost 38,000 of those bad boys. The big day was Wednesday, and those were closing. The rest of the week, 9,000 on Monday, 8,700 on Tuesday, 7,300 today. Looks like all opening the rest of the week. Again, that two strike has been very much a pivotal psychological strike. We threatened it. We kind of bounced off of it. So maybe that's why we saw a lot of opening and closing on those. But even below the two strike, listeners, we're seeing action. The 1/2 puts here. Actually, the 1/2 puts in June took the lead ever so slightly. They edged out the two puts in May by less than 1,000 contracts, by about 600 contracts. We have 38,200 of the 1/2 puts in June. Those are actually the most active contract. The big dog for those is today, 18,600 today, about 10,600 going up on Tuesday, 7,500 on Wednesday, 1,500 on Monday, opening all week long. You know, when Dan Grams was on the show with me a couple weeks ago, we were kind of remarking just how much action is going on below the two strike in nat gas and the puts. There's a ton of it. And that is clearly the case again this week. And most of it opening again here on the 1/2 puts. Given the fact that the put wing is slightly bid, you have to wonder, at least some of the folks are buying those puts. So I don't know, listeners, would you like to buy a June 1/2 put in nat gas with the underlying around 2? If you go out to the June contract, it's about a 242. You like that one? Well, clearly some folks do. 90 cents odd below where we're trading right now in nat gas. That would be a hell of a run in nat gas to threaten those 1/2 puts, listeners. Yet they're trading for size out here. Right behind it, we have 29,000 of the two puts going up also in June. The big day for those was Tuesday, 12,600 on Tuesday, 6,800 on Wednesday, 5,300 today, and about 4,800 on Monday. Again, opening throughout the week and probably opening today as well. So once again, surprising downside paper, the order of the day out here in NatGas. I don't know, Jim, does that excite you? Maybe you want to sell some of these 1/2 puts.
That's unbelievable. I mean, here we're talking $10 natural gas last summer with the Russian-Ukraine war in a hot summer. That's ridiculous. I mean, the odds of going down to 150, seem like probably less than 10% at this point. That's I would be selling them because as we get into the late spring and early summer, we're probably going to get hot weather and probably have a lot of people that are short the market begin to cover. That's crazy. That's way too cheap. I think.
even in a normal market, those would seem pretty cheap, let alone coming off the levels we saw last year. If you had told me this time last year, Jim, I'd be talking about 1.5 puts, I would have laughed at you openly. And yet that's where we are here. So NatGas, the product that keeps on giving from an options volume perspective. It's fascinating what we're seeing going up out here. Listeners. Speaking of the listeners, we'll get some more of you on here. Let's go back to Option God, looks like, and say how much, this is what you're just talking about, Jim, with Ukraine again. How much of the NatGas market is driven by Ukraine now, and how much of this is just regular old weather? We were just talking about this earlier, Jim. Usually the driver this time of year in NatGas is what's going on with the weather, right? That's the big driver, as well as maybe some shipping logistical hurdles with LNG. These days, for the better part of the last year, much of the NatGas conversation has been dominated by everything going on in Ukraine. But our listeners want to know, these days, what do you think the split is, Jim?
I'd say it's probably 80% oversupply in weather. We had, like as I mentioned before, a record warm winter, not only here, but also in Europe. We had some of the natural gas pipelines, the LNG export facilities at Freeport shut down. Excuse me. So I think that's pretty much out of the market right now, the Russia-Ukraine war. But again, all these utility companies and producers are sitting on such massive supplies of natural gas. In order to import LNG from us, right, we have to have a hot summer in Europe, or a cold winter next year to deplete all those supplies. Everybody panicked about buying all this stuff, worrying they couldn't get any gas from Russia. So it's going to take probably 6 months to a year and a half for the European nations to begin to deplete those natural gas supplies. There's just too much. And that's going to longer term help our export market of LNG. You get a hot summer and or a cold winter on top of that. And probably within 6 months or a year, maybe a year and a half, you will go back to $3.5, $4.50 in natural gas. But I don't see that happening in the next few months.
All right, everybody, that music means we've come up against it for the show this week. Jim, I want to thank you for joining us in the CME Group Hot Seat. Did you have fun, sir?
Love it. Let's do it again. Fantastic. Appreciate it.
Before we go, Jim, we got a little bit of time here at the end of the show. So if there's any other products that maybe you wanted to sneak in really quickly, or maybe any thoughts, any analysis you wanted to leave with our audience, now is the time, sir. The floor is yours.
Oh, thanks. Yeah, sugars are, I know you didn't talk about sugar, but it's produced all over the world, Thailand, India, and also Brazil. That's a play. I think we could go to $3.30 in sugar. It's around 25 cents right now with an El Nino. That could be a good play to buy calls in that. I think I'm relatively bearish soybeans, though. You have to watch this El Nino situation. Buying November puts is an opportunity. And natural gas, I'd be looking to sell put options, maybe like $2, very conservative, July or August, $2 puts. I doubt we're going to go below that. As we get into the summer, you'll begin to see short covering ahead of potential hot weather.
There we go. And Mr. Jim, if folks want to check out your analysis for themselves, maybe check out your newsletter, where should they go? What should they do?
Yeah, thanks, Mark. Yeah, so bestweatherinc.com. It's called Weather Wealth. I've been advising farmers and traders and hedge funds all around the world for 25 years. Weather has an incredible influence on many, many commodities. And that's what I do is I try to second-guess computer models, look at investor psychology, come up with option and future strategies, and also just help farmers plant and harvest crops in about 12 countries around the world. So go to bestweatherinc.com, get a free 2-week trial period of my newsletter, and email me, and I'll try to help you best I can.
There you go. Check out his newsletter, listeners. And, of course, you know where to go. to see these reports and everything else we have cooking over here on the show, cmegroup.com/TWIFO, TWIFO. That's the place to go to kick the tires and light the fires. Then, of course, if you like what you see, you want to dive a little bit deeper in some of these products and what's going on, you want a free trial of everything that Bantix folks have to offer, Bantix.com, Bantix.com, the place to go to see everything beyond the TWIFO reports. And let me tell you, listeners, there's a lot. We just scratched the surface, pace of the roll, the analytics, what's actually going up day to day in these products, how they traded, the pricing, all that fun, and a whole bunch more. You can find that at Bantix.com. That's going to do it for us on the network today. Back again tomorrow with a trifecta of content. First, noon Central, 1 p.m. Eastern. We got volatility views coming at you, breaking down the crazy week that was from a vol perspective. Should be a fun one. Then, of course, after that, for all of our pro folks, we have options oddities coming up, 2 p.m. Central, 3 p.m. Eastern, breaking down the week that was from an unusual activity perspective. Should be some fun trades to analyze there. And then after that, because we like you folks, giving you a double pro Q&A this week, Mr. Eric Kovalak joining us to answer all of your questions about all things crypto, Bitcoin, everything else out there. Should be a fascinating time. If you want to check that out for yourselves, as well as the nearly 200 archived episodes we have on the pro feed, only one place to go. TheOptionsInsider.com/pro is the place to go to learn more. Otherwise, we'll see you back here next Thursday, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.